Okay, let's jump right in. Welcome to today's Explainer, where we're taking a deep, structured look at the absolute chaos dominating financial headlines right now. If you're sitting there as a cautious beginner, maybe feeling completely overwhelmed by what the stock market is doing on a daily basis, well, you're in exactly the right place. Today, I'm going to act as your personal guide. We're going to cut through all that noise, look strictly at the hard data from our sources, and build a clear, structured plan to navigate this market storm together.
So, is the stock market about to crash? I mean, it's the #1 thing on everyone's mind right now. You're likely seeing terrifying phrases everywhere, things like parabolic meltup and the exit phase. Analysts are out there warning that risk is literally the highest it's been since 2021. So if you're feeling anxious about putting your hard-earned money into the market right now, let me just immediately validate that fear. It is completely natural to look at these conditions and wonder if the floor is about to fall straight out.
Here is our roadmap for today. 1. Are we in a bubble? 2. History's biggest market crashes. 3. Why today might be different. And 4. The smart investor playbook.
Let's start with Section 1. Are we in a bubble? Validating the market anxiety.
Look, before we throw around a bunch of financial jargon, we have to acknowledge that the market feels, well, illogical. We're in the middle of unresolved geopolitical conflicts. Everyday living expenses are skyrocketing out of control. Gas prices are going through the roof. And yet, somehow, the S&P 500 is up another 30% year over year. As a beginner, seeing this massive discrepancy between the genuine struggle of everyday life and explosive stock market growth is exactly why the alarm bells in your head are ringing so loudly.
We also have a major concern with concentration. Think about this. Just 10 stocks make up 40% of the entire S&P 500. This means if just a few of these massive tech giants stumble, they drag your whole portfolio down with them. It's dangerously top-heavy. In fact, this level of concentration actually exceeds the peak of the 2001 dot-com bubble. When a market relies this heavily on just a handful of massive companies, the structural integrity of the whole system becomes a very valid worry.
And if you want an objective measure of how stretched things are, consider the Buffett indicator. It's a famous metric used to judge whether the market is overvalued or undervalued, and it's currently sitting at 2.4 deviations above its historical trend. In plain English, this means stock prices have grown significantly faster than the actual underlying economy. Mathematically speaking, the data shows that valuations right now are absolutely nuts.
Moving to Section 2, History's biggest market crashes, echoes of the past. To truly understand the risks, we have to look at Japan's everything bubble. Starting in the 1970s, cheap interest rates flooded their economy with inexpensive money. People borrowed to invest in stocks, which drove up land values, which then allowed them to borrow even more against that land. It was this crazy cycle of exponential growth that felt like a new normal. That is, until 1989, when the music stopped. The Japanese market dropped 50%, and it took nearly 40 years, yes, 4 decades, for their economy to fully recover.
So, why does Japan matter to us today? Well, because of the structural similarities highlighted by financial analyst Lance Roberts. Today, we're also seeing declining birth rates, meaning fewer workers paying into increasingly expensive social programs. We've got an aging population drawing on benefits, a heavily indebted economy, and a massive dependence on productivity increases, things like AI, to offset employment shifts. These underlying economic fractures are what make the bubble conversation so incredibly serious today.
But hey, before you run out and panic sell everything, remember this golden rule of bubbles. The market can remain irrational longer than you can remain solvent. Meaning, prices can defy logic for years. If you try to pull all your money out, or worse, bet against it, you might go broke just waiting for the crash to actually happen. Even if the fundamentals don't support current valuations, trying to actively bet against the market is incredibly dangerous.
Which brings us to Section 3, why today might be different, the data behind the bull case.
Everyone loves to compare today to the 2001 dot-com bubble. But let's look at price to earnings, or PE ratios. That's basically how much you're paying for every dollar a company actually earns. At the peak of the dot-com bubble, the average PE was an absurd 65. Companies were valued massively without making any actual money. Today, the S&P 500 PE forecast is 28. Yes, for sure, that's higher than the 100-year average of 17, but it's nowhere near the sheer insanity of 2001.
So the crucial point here is balancing the arguments. Fidelity notes some legitimate warning signs: high debt, cash burn in some sectors, intertwined ownership, but we have to impartially weigh that against the counter-evidence.
Today's giant tech companies aren't just pipe dreams on a whiteboard. They are generating massive, undeniable real profits. Cash flows are exceeding income, and net profits are beating 5-year averages. The market is expensive, absolutely, but these companies are making an astronomical amount of money.
And here's the hidden danger of simply sitting on the sidelines in fear. Let's say you decided to hold pure cash over the last 20 years just to avoid stock market volatility. You didn't break even. You actually suffered a guaranteed 1.8% annual loss in purchasing power due to inflation. Doing nothing carries its own massive risk.
Furthermore, let's debunk a really popular myth going around right now. The idea that the stock market is only going up because the government is printing money and the dollar is losing value. Fisher Investments analyzed this going all the way back to the 1970s. The correlation between the value of the US dollar and the S&P 500 returns is a mere 0.15. That is essentially zero correlation. The market isn't just artificially propped up by money printing. Real earnings and genuine investor enthusiasm are actually driving this bus.
Now for Section 4, the Smart Investor Playbook, controlling what we can control.
We need to totally remove emotion from your strategy. Back during the South Sea bubble of 1720, the brilliant physicist Isaac Newton initially made a profit and exited the market. Smart, right? But as the bubble kept growing, he had to sit there and watch his friends get richer. Driven completely by emotion and FOMO, he bought back in right near the peak. And when it crashed, he lost everything. This cautionary tale proves that even the smartest people in history fail when they try to emotionally time the market.
Instead, consider the incredible power of just holding on. Let's say you were literally the unluckiest investor in history, and you put all your money into the market at the absolute peak right before the catastrophic 1929 Great Depression crash. If you just held your position, didn't panic, never invested another dollar, over a 20-year stretch, you still would have been up over 11% in profit, purely from the dividends. Time in the market heals almost all wounds.
And this brings us to our ultimate weapon against market anxiety, dollar cost averaging. It's the strategy of blindly and consistently investing a fixed amount of money into the market at regular intervals, say every single paycheck, regardless of what the daily headlines are screaming. It completely removes the terrifying guesswork of trying to figure out if today is the top or the bottom. So here's your ultimate, easy-to-follow advisor checklist to manage risk while still capturing that long-term growth. Step 1. Diversify across U.S. and international markets so all your eggs aren't in one basket. Step 2. Keep 20% on the sidelines in safe assets like treasuries. Think of this as your sleep-at-night fund, so a 30% market correction doesn't ruin your life. Step 3. Blindly dollar-cost average into the markets regardless of the daily news. Those who have consistently used this strategy during high volatility over the last decade have historically outperformed those who tried to time everything perfectly.
Which leaves us with this final, provocative thought. We know the market is concentrated, and we know valuations are really high. But we also know earnings are incredibly strong. You can't control what the market will do tomorrow, but you absolutely can control your strategy. So will you let the anxiety of sensational headlines dictate your financial future? Or will you take a breath, manage your risk, and confidently stick to the proven historical playbook? Thank you so much for joining me on this explainer today, and I really look forward to diving into our next topic with you soon.